ladies and gentlemen, welcome back to Kenne Stock Show. You already know what time it is. Make sure to smack up that bell and subscribe button. Share with all your friends, family members, including your enemies. Well, at 17, if someone would have told me I would be the age I am today, I would not have said yes. At 17, there are things that I did that I regret doing, which trickles down to my financials and the way I handled my wealth or handled money that I had. Now, I have 5 strategies of investments that are tremendous, which can help anyone out there grow or amass wealth, or it's slowly but surely, compounding is the best form of, wealth. So, the first thing I would say is diversification. I did not diversify when I was younger. Well, let's just scratch that. I did not even invest when I was younger. I thought about, partying, clubs, alcohol, everything else. So the 5 investment strategies that I will give you tonight is something that works for me. It's never too late. If you are at the age of 18, you can work towards that goal. If you're past 18, you can still work towards it. And it's never too late. Now, diversification. Diversification is, investing in a multitude of things. Don't just pick your money and put it in one spot, okay? You can invest in real estate, you can invest in cryptos, you can invest in ETFs, you can invest in bonds and stocks. So the reason why I say diversify is because there are high risk and low risks portfolio investments out there. If you invest in cryptos, you have to be mindful of how much money you put in there. So diversification is the most important thing when it comes to, or the number one strategy when it comes to investment. No matter what anyone tells you out there, diversify so that you even out, because you're managing you're managing your risk tolerance and portfolio. The second thing I'll talk about tonight is asset allocation. You need to allocate your assets properly. Know how much or what percentage of your monies goes into what. It could be you have 100%, okay? You can invest say 50% into real estate because it has been proven to be like one of the most stable forms of incremental growth. And so real estate investment is a beautiful one to stick to. Like if we were to break that 100 into a piece, or break that 100 into like small pieces of investments, real estate will be number one at 50%. Now, and then I will allocate maybe 20% of my other portfolio into ETFs, and maybe 10% into stocks and bonds, and then that's we're talking 80%, 5% into crypto, and the other 5% into other investments like odds, gold, silver. I gave you the opposite way of it, but that's just what I think, or how it should be done. That's just off the top of my head, just giving you numbers. So the next thing I would say is reinvesting your profits, reinvesting whatever amount of money you've made. Okay, when you invest in stocks and bonds, when you get invested in stocks, ETFs, bonds, you get dividends in the form of payments. Okay, you get payments in form of dividends. Those amounts of money that you earn, you can reinvest that to continue building your wealth or growing your more wealth. So reinvesting your dividends is something that should be considered. Instead of using the dividends as extra income, reinvest that so that it grows your portfolio and makes you retire quicker. Okay, next thing I would say is dollar cost average. Well, you've heard this terminology all over the finance department, finance, structure. It could be DCAing into a particular thing. If I ask you, do you want to buy one Bitcoin? Of course, you would say no. You don't have 35,000 or 25 or 27,000 to buy BTC. However, if you dollar cost average, because of the volatility and the price movement, it goes both up and down. And so if you dollar cost, which means going in slowly, that will help you, acquire the assets at a particular point in time and at your convenience as well as, acquiring more of that asset depending on how it goes in. And you don't feel it that much when you dollar cost average into a particular crypto or particular investments, your stocks, bonds, and stuff. Because when you set in your mind that you are determined to put a particular amount that goes into your retirements or goes into your savings account or goes into your investments account, that's technically dollar cost averaging for the long term, which basically grows your portfolio, grows your wealth. Now, the last thing I would say is always have cash sitting on the side. Now, you don't know what tomorrow holds. There was COVID-19 not too long ago, and what happened during COVID was crazy. Stocks, bonds, cryptos, everything fell off the shelf, fell off the charts. And so if you had money in the sidelines, you would have made lots of money nowadays. So always have money. I learned my lesson the hard way. Okay, always have money sitting on the sidelines for investing. Okay, because you never know what happens. Things can just fall off. Cryptos can drop. Investments can fall. Real estate can go down. But when you have cash on the sideline, you're guaranteed to make money. The greatest financial wealth is built during the time of a recession. And so, if there's a recession that is coming up, you might as well have some cash on the side that will help you continue to grow your wealth and build your wealth. So, ladies and gentlemen, those are the 5 things that I would do, or those are the 5 investment strategies that I give anyone out there: diversification, asset allocation, reinvesting the dividends into reinvesting my dividends, dollar cost averaging, and as well as having cash on the side to always insert into the market when it's bleeding. Thank you for checking out the video. Make sure to smack up that subscribe button, share with all your friends, family members, including your enemies. Don't forget them, because they need to grow too. I'll see you in the next one. Bye bye.